ready? You got me running, you got me running, got me running. Shake it, shake it, shake it, baby. Raise your hands up, raise them out.
All right. Hello, everyone, and welcome to today's call. It is Thursday, the 27th of January, 2022, and it is the post-FOMC currency call as well. So we will be going through a summary of what happened with the FOMC meeting. Obviously, the press conference had a few things to discuss, and a big welcome as well to anyone watching this on the delayed telecast with the YouTube channel. Make sure you do subscribe to the LCMS Traders Club via the Jindal Thai website if you are looking to get the up-to-date live trade ideas, and we also discuss breaking news topics as well as they come in as well, so you can keep up with exactly what's happening in the markets and take advantage of any of the trade ideas as well as they are updated. Now, just before we get into things today, I will do the risk disclaimer too. So just important to take note, we will be discussing trade ideas. We've got the yen and gold in focus today. But the risk disclaimer is that any information shared in this video is not intended to be a trade recommendation. It is solely the opinion and views of the speakers. So please remember to do your own analysis prior to entering any trades. And I will stop the share there. So again, please feel free to ask questions. But just to start off the call, we've got Kim Ong here, currency strategist with LCMS Traders, discussing the FOMC and the highlights that were in the meeting. So over to you now, Kimmy.
All right, thank you, Scotty. Happy post-FOMC Thursday, everyone. Okay, so FOMC. What did they do earlier today? Okay, basically interest rate held unchanged, okay, at the targeted range of 0 to 0.25%. QE tapering rate, okay, remains unchanged as well at $30 billion per month. Okay, so what this means is that for the month of February, they will be tapering at 30 plus 30, that's $60 billion, okay? And then in March, they will taper by 90. Hence, in March, the central bank will no longer be purchasing any more bonds or assets, okay? It's the end of QE in March, all right? So, with these two things left unchanged, okay, doesn't mean that it's uneventful, all right? Okay, because I was just talking to Scott earlier today. There's still a lot of things that happen, all right? So the first thing, okay, I would like to share is the FOMC statement, all right? When the statement was released, not too big of a price movement, I would say, okay? But the main section, okay, there are two lines here that I would like to bring your attention to, all right? Where's the first line? The first line is here, okay? With inflation well above 2% and a strong labor market, the committee expects it will soon be appropriate to raise the target range for the federal funds rate, okay? So basically what this means is that it is a new line in the statement, okay? Previously, we don't see this line in the statement anywhere, all right? So what this newly added line means is that, you know, the central bank is already ready to, you know, increase interest rate in the next few meetings, okay? Maybe the next one, all right? But I'll keep it for later on, all right? Then the second line that I would like to bring attention to is this. It's actually QE related, right? Oh no, wait, it's actually, okay, this line over here. Give me a moment. So the committee decided to continue to reduce the monetary pace of its net asset purchases, which is, well, QE, bond buying, okay, bringing them to an end in early March. So as of now, okay, it's pretty much confirmed that, you know, QE will end in March, okay? So QE ending in March, looking forward to interest rates. That's what the release statement told us earlier today, okay? So actually, I would say nothing surprising, okay? Because we have pretty much expect these two things to happen. It's just that it's not formally conveyed through the statement, right? So right now it's been formal. We can pretty much rest assured that these two items, there's a high chance that these two items will be carried out according to plan. Okay. Now on to something more interesting, more fun. Okay, which is the press conference. Several quotes I have to make over here. Okay, so as we know that the central bank, okay, actually most of the members actually projects interest rate hike. The number of times, okay, interest rates hike may take place in 2022 to be 3. Okay, 3 rate hikes. Okay, so actually right now we can actually expect more than 3 rate hikes coming from the Federal Reserve. All right. During the press conference, Jerome Powell said this. I quote, "I think there's quite a bit of room to raise interest rates without threatening the labor market." Okay, so yes, they will need to increase interest rates to tame inflation down. All right, but then the thing is, while doing so, okay, the central bank, well, not only the central bank, I would say central banks in general, okay, will have to pay attention to wage inflation as well. Okay, because when you rise, when you hike interest rates, that may actually push wages up as well. All right, and with the rise in wages, okay, may actually pose some issues because who pays them? Companies, right? Firms have to pay for, have to suffer. Okay, we'll end up suffering from the rise in wages. So rising interest rates may actually lead to that issue as well. So that is something that central banks around the world will have to pay attention to. But over here, Jerome Powell actually, I would say, give us a peace of mind, okay, saying that with this series of rate hikes coming in, okay, it is unlikely that it's going to cause a negative impact on the labor market, right? So this is actually a good thing, okay. So what this means is, the whole maximum unemployment mandate, okay, that the central bank is focusing on, all right, is, I would say, pretty much close, okay, close to meeting the requirements already, okay. So that is the first quote. Now, second quote, like I've said, okay, during the prep for FOMC meeting, we know that they're going to rate hike. We know that they're going to hike rates, okay. But when is it that they're going to do it? Okay, when, especially when is the first rate hike coming in? All right. So Paul actually said something that I would say it's a subtle hint, okay, to a first rate hike can be expected in March, okay, March this year, okay. So he said this, I quote, "With inflation well above 2% and a strong labor market, the committee expects it will soon be appropriate to raise the target range for the federal funds rate." Okay, so he didn't say as much, all right, but he already pretty much confirmed that the dual mandate of the Fed, okay, which is price stability, and price stability is not that stable right now because it's way above 2%. Okay, so it's a cause for concern, right? They need to bring it down. Okay, and then the second mandate being strong labor market, okay, maximum employment. So with this thing coming in, it's very likely that the central bank will have to act fast. Okay, if not, inflation is it's going to go higher than the most recent release of 7.0% on an annual basis. Okay, this is like at least 2 to 2.5%. 2 to 2.5 times higher than the central bank's targeted inflation range of 2 to 3%. Okay, so we can expect a rate hike to come as early as March. Okay, and then the third quote that I would like to make is this. All right, "I think there's quite a bit of room to raise interest rates without threatening the labor market." Okay, so it's something similar to the second quote. All right, but I think earlier today, okay, a couple of hours back, I was still looking at some of the press conference, what went down during the press conference, okay, and Powell actually, I think said something like, or hinted something like, we can actually expect, we won't rule out, okay, we won't rule out the possibility of interest rates hike on every meeting, okay, every meeting, okay. Keep in mind, the Federal Reserve meets 8 times a year, okay, and then right now it's January, down with 1 meeting, okay, no rate hike. That leaves it with 7 more meetings to go this year. Okay, if they are going to increase interest rate during every meeting, okay, from now on, there's going to be 7 rate hikes. All right, and they will most likely increase interest rate at a minimum of 0.25%. Okay, that means it's going to be like 1.75%. So plus the current 0.25%, okay, we may very well be seeing US interest rates, okay, to be at 2% by the end of this year. Okay, by the end of by the end of the final meeting of the year in December. Okay, so that is definitely very, very, very hawkish. Okay, comparing with the fact that just recently they were just saying that inflation is transitory, less than 6 months ago, right? Right now they feel that inflation is really like catching up very fast, and they are pretty much in hot soup. Okay, hence the aggressive the possibility of an aggressive rate hike. All right, so that is for interest rates, and that is for QE. Okay, QE expected to end in March. More interest rates can be expected. 3 is pretty much I would say, underestimate already. So we may actually be hearing more from Wall Street, okay, analysts, banks, and things like that, economists coming in to probably forecast that, we have revised our expectation of interest rates hikes to, I don't know, 6-7 times a year. Okay, 6-7 times this time around. Okay, we may even see something like 8 or 9 times. Okay, how is it possible when they actually have like 7 meetings to go, right? So every single time of rate hike is pretty much considered as 0.25%. Okay, so if you guys were to read somewhere that banks are expecting 10 rate hikes, okay, a bit extreme, but 10 rate hikes, that means they are expecting some of the rate hikes carried out to be 0.5%. Okay, hence equating to 2 rate hikes. All right, so that's for rate hike. So another thing that we are focusing on is balance sheet. Basically, the unloading of bonds, okay, from the Federal Reserve. So we were supposed to focus on the timeline, okay, if any information would be provided, but unfortunately, okay, no timeline on unloading of bonds has been provided by the central bank. Nonetheless, okay, they did release a statement, a short one. Okay, let me bring you guys to this. It's called the Principles for Reducing the Size of the Federal Reserve's Balance Sheet. So, long story short, well, it's really short, okay, but long story short, it's a hint. Okay, it's a hint. It's pretty much, telling us that the central bank, the Federal Reserve, is ready to unload bonds. Okay, that's why they are providing this 1, 2, 3, 4, 5, 6 point form in this statement, describing, roughly how they're going to go about carrying it. Okay, although they did not mention when. All right, a particular statement over here, line that I would like to bring your attention to is where is it? Okay, over here. The committee expects that reducing the size of the Federal Reserve's balance sheet will commence after the process of increasing the target range for the federal funds rate has begun. Okay, so what this means is pretty straightforward. Okay, suppose the Federal Reserve were to increase interest rate in March. Okay, then the next meeting after March, we can expect the central bank to start to sell back bonds into the market. All right, that's what I was trying to say. All right, and I think over here, did they actually mention this? Okay, they did not. They did not mention it here. Okay, but I think I've highlighted it several times previously already. Okay, and that is the central bank. Okay, is expecting the unloading of bonds, the rate of unloading of bonds this time round, okay, to be faster than the previous time that they carried out, which was, I think, back in 2017 or 2016 or something like that. I can't remember exactly the timeline, okay, but previously it was because of the 2008 financial crisis. Okay, that's when they carried out, well, as usual, print more money, quantitative easing, buying tons of bonds, right? And then when they start to unload it, it was at a certain pace. Okay, but this time round, when they were to start, when they start this whole unloading process, it's going to be faster than the previous time as compared to the previous time. Okay, so why is it so important, right? That this the pace is faster and things like that. Okay, because if you guys were to look at the US, actually I'll just go over to the chart and show you guys. All right. So if you guys would look at the S&P 500, yep. So okay, let me just get the candles out. Oops, what happened to this? Compare. Nope. Wait, why is it that I cannot get my? Okay, never mind. Let's just stick with line chart. All right. Going down to 1 hour time frame. Wait a minute. Okay, I don't think I'll be able to switch it right now. But okay, as you can see, let me just put an arrow over here. That is, okay, this arrow is actually indicating the 24th of Jan, okay, which is yesterday, right? Correct. You know, not yesterday. Oh, wait a minute. I think this chart is not it's not loaded. Okay. Well, no problem. Okay, if you guys were to look at the charts from let's see. Okay, never mind. I'll show you guys the chart later on, all right, when I talk about the chart. But basically what I'm trying to say here is this, all right? When the FOMC actually announced the decision, and of course with the press conference, okay, there was actually a strong sell-off in the US equities market, okay? Hence, the S&P 500, NASDAQ, and Dow Jones Industrial Average actually took a hit, all right? So why is that the case? Okay, because think of it this way. When the Federal Reserve actually starts buying bonds, they are actually, well, it is actually providing support to the market, right? Providing liquidity to the market. And that's actually a good thing, all right? That will definitely lead to, that will, I would say, spur more trading activities, investments, and things like that in the equities market, okay? Now, once the Federal Reserve, okay, starts to pull back the support, okay, meaning selling back the bonds that they're holding at the moment into the market, you know, saying that, okay, now you guys are good to go, right? I'm going to just, you know, we are just going to stop all this support. We're not going to buy any more bonds, all right? We're not going to provide any more support. And on top of that, we will be selling back the bonds into the market, okay? So you guys will have to take care of yourself from now on, all right? But we're going to do it like on a progressive manner, okay? Not like at one go, okay? So when this happens, there tends to be some form of a knee-jerk reaction in the equities market, okay? Because the Fed is no longer providing any more support and you guys are on your own right now, all right? So with that, chances are the knee-jerk reaction that may occur, okay, is a strong sell-off in the equities market, okay? Which is why, you know, later on I'll show you guys a chart. We see a weakening in the equities market, okay? So that is pretty much it for the FOMC, okay? The next meeting will be held on 17th of March, okay? Taking a break in February, okay? Coming back in March. And by the way, the quarterly economic projections will be released, okay? And my belief as of right now is that there's going to be another round of fireworks in, you know, during the meeting, okay? Because I'll be very, I'll be paying a lot of attention to the what do you call it, the dot plot. Okay, I would like to see if more members are actually expecting more than 3 interest rate hikes this year. Okay, so that likely there's going to be a revision in the economic projection materials in terms of inflation forecast, in terms of GDP forecast, and of course, number of times the Fed is going to increase interest rates in 2022. Okay, so with that, any questions on FOMC? If there's no questions, all right, I will hand it over to Scott for his analysis of DXY. Okay, back to you, Scott.
Thanks for that, Gimme. And again, guys, make sure you catch the re-upload of this as well. If you did come late into the live call as well, and if you need to watch it a couple of times, because there were some critical points from the FOMC press conference as well, that definitely will help sort of the trajectory of, you know, where markets are heading. And I'll just share the US dollar index now. So this is the 4-hour time frame, and we're currently seeing some more strength here. We've got 96.60 is where we're at. Now, I was looking at the chart from a lower time perspective. We've seen, now this isn't a point of resistance, but we have seen price being challenged here at around 96.66. So that's going to be the first test. And then the second will be the more significant one where we've got 97. So we did see the US dollar significantly strengthened once the announcement was made. So we saw there was quite an aggressive wick on that as well, where we actually punctured back below 96.00. The trajectory does seem upwards, and it does look like the break of 96.66 and then 97 in the coming days is likely. And we could see a little bit of a rally in equities perhaps tonight. So that typically will lead to a little bit of a sell-off if we are seeing money come out of the index. Gold as well is pulling back. So I'd be interested to see what happens there. And I just want to have a quick look at the news now as well. So we did go into detail about the main events, which was earlier this morning in GMT +8 time zone. So for tonight, we've got some GDP data out, which is interesting. So quarter on quarter for the advanced GDP is expected to be 5.3. Now the previous quarter was 2.3. So that is interesting. That's quite the increase there. We've got the GDP, or the advanced GDP price index quarter on quarter, 6% previously. So that's flat. Core durable goods orders, a little bit weaker, it looks like, as well. Unemployment claims, a little bit down as well on what we saw previously. That's a weekly figure though, so it's not that price sensitive, but a little bit going on just before an hour before the US equity markets open. But what I have been seeing, the Australian market is down today a little bit. We did try to rally at the start, but that's been sold off. And we've got some bounces going on now. We'll just see if they can hold up. I'll just quickly go into that. I did make the live trading earlier today, the 7 to 8 o'clock cold GMT +8, but just want to go back and just see what's going on now, just with the Australian session playing out. I'll just quickly go. This is the main index, S&P. This is the ASX 200. So we saw that's what's going on. So from a 4-hour perspective and now a daily, we saw 6,800 actually break, which is pretty significant. We didn't see levels broken there since we're going back April 2021 or so is when we've seen it go below there. So it's quite significant. We have seen a bounce on the hourly just to see what it's doing leading into the midpoint or lunchtime of the session for us here in Perth. It needs to really get back above 7,000. So it's a challenging market to be in a swing trade. I'm just playing it quick in and out. And again, that translates to Forex. It's looking like anyway, unless you are in a long US dollar pair. But again, that if you are someone that likes tight stocks, just be wary that there can be a lot of volatility around this time. So be cautious. But my thoughts on the US dollar really is long biased. I'd like to see maybe a little bit of a pullback back below 96.50, and then up we go today. And then most likely tomorrow, it's probably going to eventually get back over 97 after a little bit of it looks like the fake outs on the upside with equities are just being sold into. So I think there's no reason to say that's not going to, unfortunately, if you are a bull, it's going to get any better. So I would just say be cautious and use a little risk as well that you normally do, just with all the uncertainties that are in the markets. But those are my thoughts there, guys, with the US dollar and a little bit on equities. Now, we do have the yen and gold in focus as well, just to finish the call up with Gimme. So I'll hand it back to you.
Okay, so before I head over to the yen and gold, as promised, what you're looking at right now, okay, are the 3 major equities indices of the United States. Okay, The top one being the S&P 500, okay, the middle one being the Nasdaq 100, and the third one at the bottom is the Dow Jones Industrial Average. So as indicated by this downward pointing arrow over here, okay, you see that it actually corresponds to the timing that the press conference, okay, the release of the announcement, okay, FOMC announcement was made. So we can see that there's actually a strong downward move, all right? So it's really just a sell-off from the market, okay? And we'll see how it goes when the US market opens again tonight, all right? But at the moment, it seems like the hawkish message sent by the Federal Reserve is still having some strong impact on the equities market, all right? So just want to show you guys this chart and, just to show you guys how it actually reacted to the Federal Reserve decision. Okay, now back to dollar yen. Well, specifically the yen pairs. Oops. Okay, dollar yen on a daily time frame, we see that it strengthened. Okay, the US dollar, well, obviously it strengthened, okay, over here against the Japanese yen due to the hawkish tone. But the thing is, it's actually approaching my resistance of 115 at the moment, all right? So will I be looking for selling opportunities on dollar yen? No, okay. I'm more keen to look for buying opportunities, okay, when it actually breaks above the 115 resistance, all right? So I actually have my entry level at 115.3 over here, and my stop loss would be below my, well, by then it will become a support, okay? Support of 115, which is 70 pips. And then I'll be looking to buy all the way up to 116.2. Around this level over here, because dollar yen has been trading quite high earlier on this year, January 4th, okay? And if we were to zoom out, we see that dollar yen is really, really very, very high, okay? Forget it. Let's just go to weekly chart, right? The last time it was actually trading higher than that. Oh, let's go to monthly chart. All right. Okay. We can see that, the last time it was actually trading higher than the current level was back in 2017, January 2nd. Okay. It's like 5 years ago. Okay. So we're actually at a 5-year high level. All right. So I wouldn't dare to, go anything higher than that for the time being. Okay. So I'm just going to keep my trade. I wouldn't say short term, but at the short to medium term kind of take profit level. Okay, so 116.2 for my take profit level will be fine. Okay, that will be something slightly higher than 1:2 risk reward. 1:1, sorry, something slightly higher than 1:1 risk reward ratio. Okay, in a scenario if we bounced off my resistance of 115, unless there is a strong conviction. Okay, otherwise, nah, I'm not going to do it. Okay, I'm not going to be looking to sell dollar yen. Okay, and you can see that at the moment the H4 candle, okay, yes, it tried to move lower, but then at the moment, okay, I think it's probably, yeah, at the moment it's really just like, strong pushback up, by the bulls. Okay, so there may be some issue with breaking above this 115, but in the scenario whereby it does, yeah, look for buying opportunities at 115.3. Okay, so that's for dollar yen. Bullish on the US dollar. Okay, now next euro yen. Okay, so euro yen on a daily time frame. Okay. Okay, so we can see that it's, yeah, a couple of days back it came down close to my support of 128, but then actually bounced off, right? And at the moment, it doesn't really seem to be keen to, move down lower much for now. Okay, so I will still be looking for buying opportunities of euro yen. Okay, but I won't be buying like right now or something like that. Okay, I will have to wait because let me just add one line over here. Because if you guys realize the 129 key level, okay, is just above the, well, euro yen has been trying to break above the 129 level for like 2 or 3 times already. Okay, so ever since it actually break below on 21st of January, a few days back, I think last week. Okay, it's been trying to go above. Okay, but to no avail, right? It failed to do so. So right now, okay, my plan is this. Okay, it will be like a buy limit kind of entry. Okay, so basically, I will still be waiting for Euro Yen to go lower, to move lower to the 128.3 level, okay, before looking for buying opportunities. So you guys can actually set a buy limit entry at 128.3. So once it actually hits there, okay, and then bounced off this resistance zone of 128, okay, then it will be a buy entry, and then my stop loss would be below my support of 128, which is at 127.8, a 50 pips stop loss, okay, and then my take profit would be at 128.9, okay, which is 60 pips. So I'm still not expecting Euro Yen to break above 129, unless there's really a hawkish tone coming from ECB, which is unlikely going to be the case right now, okay, because we know that they're going to end the PPP in March, but then they're going to increase the bond buying under the APP, okay, by a certain amount, specifically for 40 billion euros per month. All right, so it's not very hawkish from their side. All right, and right now with all this whole geopolitical turmoil coming in, it's more likely than not that the euro may actually weaken against the safe haven currencies like Japanese yen. Okay, not so much of the case for dollar yen because we have hawkish tone coming from the FOMC and things like that. So dollar yen, we may still be seeing it moving higher a bit, okay, although there's a resistance, okay. So euro yen, yes, I'm still be looking to buy, but this is more like a wait for a retracement down to the 128.3 entry level, okay, before looking for buying opportunities, okay. So that's for euro yen. And the last yen pair that I'll be talking about, pound yen. On a daily time frame, okay, right now it's really bounced off the support of 153, okay, and then right now it's slowly moving downwards, okay, and then going down to H4 time frame, okay. We see that for the past 3 H4 candles, okay, yes, it tried to move lower, but then you can see, okay, let me just zoom in, you can see that there's actually quite long lower shadow, lower tail, lower wick, okay, from the candles, okay. And then the second one, it tried to go lower, but then come back up. At the moment, okay, the current candle, you can see that it still has a long lower shadow, okay. It's probably like some, I don't know, what do you call it, like a dragonfly doji or something like that, for those candlestick patterns traders out there, all right. So we'll see how it goes, okay. But in a scenario whereby the bulls actually, outrun the bears, okay, and push price up to 154.3, I will be looking for buying opportunities at that level, okay. And then my stop loss would be below 153.8. Sorry, it will be at 153.8. Actually, I should put in a line over here, okay, 154. Now you know why there's like this long shadow, right? Because pound yen is actually trying to break below 154, but then I guess there's no strong conviction out there, okay. And at the moment, Bank of England is rather hawkish, and they are expected to increase interest rate during the next meeting as well, okay. So are they ready to test below? Are they ready to trade below 154? Okay, after it has broken up, days probably earlier this week, okay. That's the question, all right. So in a scenario, if we were to break below, then too bad, I won't be looking for selling opportunities because I will be trading into my support of 153, which is not good, right? But in a scenario whereby this 3 attempts to break below 154 fails, okay, and it actually bounced back up, okay, resuming its short-term upwards trend over here, okay. Let's just put a line over here to indicate this recent short-term trend, all right. In a scenario whereby it were to bounce back up, resume this upward trend, then yeah, I'll be looking for buying opportunities, okay. And then stop loss will be at 153.8, 50 pips. Take profit would be 154.9, okay. I'm trying to keep this short term, all right, because yeah, it's just too much going on right right now. Okay, geopolitical issues, and then COVID, Omicron, and then right now there's this whole hawkish tone from FOMC. Although it's unlikely going to have a direct impact on yen pairs, okay, pound yen especially, but still, it's likely going to have some movements and things like that. All right, so pretty much close to, well, slightly more than 1:1 risk reward, 50 pips to 60 pips. Okay, so that's for pound yen. Okay, let's move on to the last instrument for the day, gold, specifically gold against the US dollar. Okay, so we see a strong bearish move from gold yesterday. Okay, well, specifically due to FOMC. Okay, so why not, let's just go to 1 hour time frame to show you guys the direct impact of the FOMC. Okay, so over here, 0300 GMT plus 8. Okay, that was when the FOMC announcement was made, and then at 3:30 GMT plus 8, the press conference was held. That was when the chief of the central bank, Jerome Powell, actually delivered a hawkish and more hawkish tone during the press conference. Okay, so because of that, we see gold actually took a hit. Okay, doesn't come as a surprise because we know that there's a what do you call that, inverse correlation between US dollar and gold as well. All right, so that hawkish tone, okay, strengthen US dollar. Hence, we can expect the gold to actually weaken against the US dollar. All right, so at the moment, okay, it's actually trading at 1816. Okay, so let's just go back to H4 time frame. All right, personally, okay, I don't trade gold, okay, but if I were to trade gold, I won't be looking to buy at the moment, okay, because it's just, the FOMC is just too hawkish at the moment for me to actually buy gold up, okay, unless there's some new, I don't know, developments that can actually weaken the US dollar, okay. Otherwise, right now, I'm only looking for selling opportunities, okay. And if gold were to hit the 1810 level, okay, that would be my sell entry. All right, and then my stop loss will be at 1280, 1820. Okay, and then my potential take profit level would be at 1790. Yeah, as usual for gold against the US dollar, try not to hold the trade for too long. Try not to. Wow, I mean, yes, it's hawkish Fed coming in. Okay, but there's just too much going on right now. All right, and if you guys can actually get some profit out of this whole trade, just take it and leave it, or I mean, take it or leave it. Okay, I prefer you guys just take it and run. Right, just try not to hold it for too long. Okay, because it's just too crazy already. So, but at the moment, yes, hawkish Fed, strong US dollar, weakening of the gold against the US dollar. Okay, so that is for the gold trade. Any questions on FOMC or on any of the trade ideas being shared? Okay, so if there's no question, all right, I'll be posting the price levels in the club, okay, Traders Club EcoFin platform. All right, so don't worry about the levels for now. Okay, if there's no questions for now, I'll hand it over to Scott.
All right, thanks for that, Gimme, and thanks for everyone joining in the call. And again, feel free to ask any questions to the LCMS Traders Club members in the chat. We will be around all day and into the evening as well. So have a great rest of your day, everyone. Thanks for joining us, and we'll see you tomorrow for CAD, oil, and crypto. Bye for now.